Hey, what's up, Market Moose? My friend Moose on the loose. Happy Thursday. Today we're gonna take a look at where can you hide during a recession or a market crash, right? Because again, I see a lot of investors feeling nervous about the market these days. You look at the earnings; they seem to be propelled by AI for a while now. We just like have this feeling that maybe we're building a bubble that is about to burst. Whenever we have a bad news, the market goes down quickly. So there's a lot of nervosity here, and it's pretty much the best time right now to see how you can protect your portfolio. Where can you go and hide during a recession? And the solution is not to sit in cash, because if you've been using this solution, chances are you've been sitting in cash for a few years now, because this is something that has been a recurring problem over the past few years. The stock market is playing some tricks with us, trying to convince us that the market is about to crash anytime soon. And it's been 3 years now. And if you're sitting on cash, you missed a ton of great returns, and that money is never going to come back. So now it's time to take a better look at that and see how you can protect your portfolio in a better way. So step number one, your plan, actually, your investment plan, your retirement plan should include a market crash, a stress test, right? If you have not done this already, there's a problem. And actually, it's a good thing. We are in the last days where Retirement Loop is open, because you can build your retirement plan and you can stress test your portfolio inside of Retirement Loop. We have opened our doors last week. We are closing them next Monday on the 24th. So you can join at retirementloop.ca/join. You only have 4 days left to do that. So if you're curious and stressed about your retirement, well, we can help you build a plan, double check it, stress test it, and then you can enjoy retirement the way it should be. So what do I mean when I say that your plan should include a market crash? Well, you should already know that in the next 20, 30, 40 years, you are going to face more than one bear market, right? That's going to happen regardless of what you think or like or whatever is going to happen. So how can you protect your portfolio against that? Well, unless you stay in GICs for the next 25 years of your retirement, there's no other ways that you can protect it. So the point is to see, can I take a 25 hit on my portfolio and still be okay at retirement? And if the answer is yes, even though we all hate losing money, it won't matter, because the point here is to make sure that our retirement goals, the retirement lifestyle that we want, can keep on going even during a bear market. So having a plan that covers that, it's step number one. Step number two, well, right now is probably the best time to think about your volatility tolerance. In the market, we always talk about risk tolerance, but really it's not really risk, it's volatility. Because when you think about that, the safest way to invest your money for the next 25 years is in the stock market. But it's also the most volatile. And the problem with our brain is, as soon as we see a trend going down, our brain is pushing that trend all the way down to zero. And then we fear that we're going to lose too much money. We fear that we're not prepared, and we fear that we're not going to have the retirement lifestyle that we wanted. And then we panic sell. This is usually what we see when investors are afraid of a market crash. But right now, we are trading close to all-time high. So it's pretty much the time to think about volatility tolerance and how much you can stomach. If you're telling me, Mike, I can't stomach a drop of like 10 or 15%, well, then you should not be 100% in equities. You should look for other sources of fixed income, even though the returns and expected returns is likely going to be smaller than stocks. You don't have the stomach to go through a market crash that will destroy your portfolio by like 20, 25, 30% for a short period of time. But it's still, you're going to have to live through those emotions and hold still during the entire period. Maybe it's going to take 1, 2, maybe sometimes 3 years to recover. Are you able to do that? This is the question that only you can answer, but it's really important that you go through that process today so you can protect what you have earned already. It's not the time to review your risk tolerance and volatility tolerance once you have lost money, because of course you're going to be more afraid, you're going to be thinking about that. So review your volatility tolerance right now and then take action. And to take action, I mean, it could go into some gold as a store of value. You can go into fixed income, GICs, creating bond ladder, but there's also something that you can do for your stocks. So on step number 3, there are ways to kind of feel a little bit better or safer about your stocks. And here I'm not telling you that if you invest in stocks, if you invest in ETFs, but like on the equity side, you're at risk. You're at risk of volatility. That is for sure. You're not going to avoid that. However, if you focus on some sectors, such as the consumer staples, for example, if you go for the companies that have a long history of going through recessions and still performing, survive and thrive, right? Well, those are companies that will likely do well during the next recession. I'm talking about those boring stocks. Not exciting, probably not driven by AI, but they have been around for ages. They have continuously increased their dividend. I mean, you know me, I'm a dividend investor, so I'm going to talk about dividend growth investing. But when I find companies like Fortis or Canadian Natural Resources or Canadian banks that have went through major catastrophes and yet always delivered to their shareholders, well, there you go. I'll feel a lot better having those in mind. And that obviously starts with having companies with robust metrics. The fundamentals. Forget about the narrative. Forget about the stories you tell yourself. Forget why you are so excited about the next product or the next innovation that is going to come up with this company. Focus on real numbers. To help me out analyze stocks, I focus on the dividend triangle. So I look at the trend for revenue, earnings per share, and dividend over the past 5 and 10 years. So when I see a stock that continuously find ways to grow their sales and then increase their profits and then increase their dividend, well, I know this business has robust metrics. And chances are, in my second layer of analysis, I will discover that this company is pretty good at generating cash flow, that will probably have a clean balance sheet with not too much debt, and will have several growth vectors and low payout ratios, and all the other metrics will fall in line because I started by identifying companies that are able to grow their sales, grow their profit, and grow their dividend on a consistent and sustainable ways. And this is the best way to start when you look at your portfolio. Go stock by stock if you have stocks. If you go for ETFs, look at the diversification and the top 20 holdings to see if they are quality companies, and focusing on quality, focusing on companies that are growing right now. I mean, in investment, offense is the best defense. If you invest in companies that are growing right now, chances are, yes, they're not going to grow as fast during a recession, but they're still going to be able to survive and thrive. If you invest in struggling businesses right now, what do you think is going to happen when they hit a wall? Well, dividend cut, loss of capital, you know the story, big layoffs, and then a lot of uncertainties. Finally, the last pick, super important, avoid bets and riskier plays. What I mean by that is anything that you're not 100% sure, anything that has like weaker metrics like no revenue growth, declining earnings, no dividend growth for the past 5 years, a high yield, or on the other side, companies that have been skyrocketing like there's no tomorrow over the past 3 years. Maybe it's time to slow down on those. Yes, you can have some. That's okay to have some. I do have some in my portfolio. That's not a problem. But if the majority of your portfolio is invested on bets and speculative plays, well, you're putting your retirement at risk. And you may not want to do that as you walk into this last phase of your investment life, right? So you want to make sure that you have a plan. You want to make sure that you have stress test it. You want to make sure that your personality is aligned with your investment strategy. So your risk tolerance, volatility tolerance are aligned. You want for your equity stock option, your equity portion of your portfolio, that you focused on companies with robust metrics rather than robust narratives. And finally, you want to avoid having multiple struggling companies or mature businesses going nowhere with no dividend increase, or avoid making a lot of bets or a lot of, oh, I think it's going to be better, or I think they're going to do that. Well, less thinking, more numbers. Let the financial metrics drive the narrative at this point. It's going to be a lot better. Again, those are the last days to join Retirement Loop. We're closing the doors on November 24th. After that, we're not going to reopen for at least 6 months. And it is also the day that we start the 21-day Retire Each Year Plan Challenge. In that 21 days, you're going to go through your mindset, build your vision of retirement, look at your budget, creating an agile budget. And then on week 2, we start planning. So we run multiple scenarios, we use optimizers, we go through the entire retirement loop spreadsheet to make sure that we have covered all angles and you have a plan. And then on week 3, we take action. You're going to get your plan reviewed by our retirement coaches. You're going to stress test your portfolio. You're going to prepare it to create income and make sure that you have the right sequence of withdrawals. And we are going to manage all the risk around your portfolio and around your retirement within this week. So again, you can register at retirementloop.ca/join. Last week to do that, actually last 4 days, doors are closing on the 24th. retirementloop.ca/join. All right. Take good care, Moose, and we're going to talk again tomorrow. Until then, don't forget to stay invested.